Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Wednesday, July 24th, 5:18 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Nowhere to hide Wednesday is what we might call this video. Market state downgraded to correction. We're now more than 4% off of the high for the S&P 500. Even worse, NASDAQ 100 almost 8% off of its high. And that really tells the story about where the bulk of the selling is coming from, as all the money, all the hot money that flowed into the big tech names to push the indexes up over the first 6 months of the year has decided to do an about face and exit big time out of those names. Check the trend gauge over here. Joining the downtrend red arrow for market leaders is now the short-term trend, as clear break of the 21-day moving average for the S&P 500 joined the NASDAQ 100 today. Still have small caps above the 21 and mid caps sitting basically right on the 21. Dow also broke the 21 today, but the way we weight these, this is enough to push this into red arrow territory. Also had the NASDAQ 100 do a sharp break of the 50-day moving average. That's our long-term trend. S&P 500 closed basically 1 point below the 50-day moving average. So because of those big heavy tech weights, that's what's pushing those indexes around. The other three indexes, the Dow, mid cap, and small cap, still firmly above their 50-day moving average, and all five still above the long-term 200-day moving average. Maybe it's time to remind you the market never gets into serious trouble. And when I say serious trouble, I'm talking bear market territory, 15, 20% corrections, until the S&P 500 breaks below the 200-day moving average. That's where all bear markets historically occur. So what happened today? The Last night, Google and Tesla reported earnings. The initial reactions were up for Google and down for Tesla. Then the conference call started, and the more Elon spoke, the lower the stock went. Ended up opening down almost 10%, closed down 12% on the day. Google, their CEO was talking about that in the situation that we're in with emerging technologies, you better spend the money to not get left behind. And that increased CapEx spending without a clear path to profitability seemed to scare some people. And Google ended up down today by 5%, so turning a small loss into or a small gain after hours initially into a loss. The indexes all gapped down, and there was really no buyers to be found today. Every bid was hit, and we just trickled lower and lower as the day went along. Heavy selling, bears take control. That's the headline for tonight. Here are the numbers, and they're not pretty. 21 over 21, quote unquote, leaders list, only one up, and that was Bitcoin, 20 down and down severely, quite a few of them. The big eight down an average of 5.04%. Tesla, as I mentioned, down 12.3%. The RG8 hit hard as well, led to the downside by the two ETFs that you really want to see outperform. FFTY down 4%, ARK-K down 6.4%. RG8 down an average of 3.12%. S&P 500 opened up down a little less than 1%. Lower, lower, lower throughout the day, ended up down 2.3%. Equal weight, a little bit of a port in the storm, as there were a few sectors that ended positive. It was mainly the tech sectors that drug the S&P down, but equal weight only down 1.17%. NASDAQ 100 down 3.6%. Equal weight NASDAQ 100 down 2.4%. Dow down 1.2%. Mid caps down 2%. Russell 2000 down 2.1%. Mid caps and small caps were holding up extremely well until afternoon selling took over, and they went from massive outperformance to just barely outperforming by the close. Global diversified 60/40 stock and bond down 1.26%. Our flagship GROTECTION portfolio down 1.83%. A little bit of outperformance versus the S&P, but more stops hit, our exposure reduced. We basically go into very defensive trend, very defensive action when we break the 21, get closer and or threaten to break the 50, and see the NASDAQ 100 break the 50 days. So we migrate to a stay out of trouble portfolio. It's tread water time to keep your head above the water and wait for better times to come. They always do, or historically they always have. We don't predict when. We certainly didn't predict this harsh of a sell-off over the last 2 weeks, but we will monitor the market as we do every day. We hope you heeded our warnings of a couple weeks ago, the flashing yellow light about how ridiculously extended we got on the NASDAQ 100, and you've watched us pull things back as things deteriorated. And stick with us. Stay with these videos every night. We'll point out the bright spots and we'll stay in sync with the market. Let's get into it now, and we'll start with the S&P 500. And you can see the big ugly bar here. Let's go to a 5-minute chart, and that's just a big, broad trend down day, starting with the gap down, little anemic bounce, 14 points. Midday before more selling into the close. Ugly day, sitting basically right on the 50-day moving average. Now here's the ugliest. 503.52 is where we were when we alerted and put the yellow light out that we were too extended, all the way down to 463 since then, and breaking very clearly the 50-day moving average today. Again, no buyers anywhere to be found on this chart. Let's go to the NASDAQ 100, the Dow, the third of the big cap indexes, and it broke back below 40,000 and a mild close below the 21-day moving average. So that 40,000 breakout now negated on the Dow. Let's go to the mid cap index, still above the 21-day moving average, sitting right on that 3,000 level. And the best looking of the indexes, although sellers did come into this in the afternoon as well, but just pulling back to the 8-day exponential moving average, well above the 21-day moving average. And that's the Russell 2000 small cap breakout, still intact there. Let's look at a 5-minute chart here. Look how it held up most of the day until right after 2:15, we broke hard in two waves to the downside. So this was a port in the storm for a while. When we broke, we gave up our TNA position and also our SDVY position, which were 2 ways of exposing. And really, that's just a market call. That's not a technical call. If we're going to continue to sell off small caps and mid caps, we would expect to get sold off as well. So we're not looking to be a hero. We're looking to preserve capital in this market. Let's take a look very quickly at the equal weighted indexes. And the RSP just barely below the 21-day moving average. So really not a difficult pullback at all from an equal weight standpoint. And you can see the last 2 weeks of relative strength here on this equal weight index. Equal weighted NASDAQ 100, on the other hand, a clear break below the 50-day as well. Very obvious failed breakout, as it's been all kind of selling in tech, not just big tech, that's taken over that index as well. Let's go to the VIX. Big move up on the VIX today, 22.6% above the 18 level. Danger Will Robinson is what this tells me. And you don't have to look hard to see the red numbers on most tickers to get the point. Here's the dollar pulling back below the 200-day moving average. No real serious moves in the dollar, so you can't look to external factors for this. This is just people deciding that they're getting out. How about precious metals? Gold gapped up, sold off. ended up down on the day. GDX, gold stocks, gapped up, sold off, and silver down 1% as well. Bitcoin loan barely poured in the storm, did end up at the close near the close, closing near the lows of the day. Inside day gave it up, and this is not highly correlated to stocks, but you can see how it has been trending higher over the last 2 weeks, while very clearly the Nasdaq 100 has been trending lower. But we're not going to take an oversized bet in Bitcoin to hope to preserve some capital. We do have a position, but it's our usual small position that we take for this. Moving on to bonds, BND, broad bond index down 0.29%, breaking the 21-day moving average. DLT, what we're seeing here is the long rates moving up. You can see a break, bonds breaking below the 50-day, 200, and 21-day moving average now. And then that's been happening for about 4 days now. Let's look at the TYX. This is the 30-year yield. Broke this downtrend line 4 days ago, now breaking above the 50-day moving average and the 200-day moving average. What's happening is the yield curve is becoming less inverted, as the expectation is for cutting short-term rates, but long-term rates are rising. Let's go to the 10-year finally. And the 10-year up 1.1%. That is our inter-asset correlation portion of the show. Let's go to the tail of the tape. We're on a bear case now, sustained break below the 21-day moving average. We broke it on the 19th, broke it again today. To get back on the bull case, we need to initiate a rally and regain the 21-day moving average. And we're talking really about the S&P 500 and the Nasdaq 100 here, as those are the big weights. A little bit of news. Obviously, the news is the sell-off, but we do have some inflation data coming later this week, Friday morning, PCE inflation data. Day count after 1 day consolidation yesterday with a week close, down 1, and then boy, it was a down 1, wasn't it? 8-day exponential moving average, the S&P 500 second close below, first close below the 21-day, breaking a long streak. As far as sectors go, the only 2 sectors that were up, utilities and healthcare. XLE, I guess, was basically flat as well. To the downside, we were led by industrials, and then CK and Y, the 3 tech sectors. That's communication services, tech, and discretionary. And inside discretionary is where Tesla resides. Portfolio. We did 2 recent ads on SSO relative to the 21. Stopped out for small losses on that. Also exited TNA and also SDVY. Those were our 2 small cap proxies. SDVY is a dividend related ETF for small caps, but I got to get that in yellow as well. And also Apple. We stopped on that on the break of the 21-day moving average. Apple holding up the best of the big 8, but certainly didn't want to give back our gains that we had on that since its recent breakout out of its base. So we went ahead and booked that. We trimmed some SPXL and UPRO. Those are our ETFs that we play the S&P 500 with. We trimmed some NVIDIA on a break of the 50-day moving average. We closed our SQQQ as we got extremely extended to the downside. That reduced our beta significantly from 1.03 all the way down to 0.68. As long as we hang above the 50-day moving average, we'll keep this around 0.6, 0.7, 0.75-ish, depending on if any opportunities in individual names come up that are very compelling. But right now, like I said, time to keep the powder dry and wait for better days. Some keys to watch for tomorrow. How does the S&P 500 react now that's sitting on the 50-day moving average? Can the Nasdaq 100 stabilize with the harsh break of the 50-day today? And if it bounces back into the 50, it's about 1.9% below the 50-day. Will that be an opportunity to re-short it using SQQQ or QID If we fail on a bounce into the 50-day moving average, which often happens after the first time you break a key moving average like that. And we also want to see if the relative strength in small caps continues. But the bottom line for the day, bears firmly take control as big tech selling intensifies. And it seems like a good time to bring in our expectations chart. And this is kind of describes the way we allocate money, client money, into the market, depending on the overall health of the market. And we break it into a few different categories. Bull one and or bull two is where we have been since the beginning of November. We did experience some outperformance, not as strong as we'd like, and that's mainly because of the heavy weightings in the S&P 500. So when the correction started, we went from bull one to a bullish pullback. That's up to 4% off of the highs, and we pierced that level today. So we're in this correction one, mild correction, 4 to 8% on the S&P 500. And this is our expectation of basically how we allocate capital and what clients should expect to happen as we address what's going on in the market and making our buy and sell decisions. So we get down to 8%. So going from 4% to 8%, only having a beta of a 0.6, obviously we're going to lose less than the market. If we start to accelerate back up, there could be some minor underperformance because arguably with a 0.6 beta, we can't outperform because the beta of the S&P is a 1. So this is historically what we see the numbers for what our performance is relative to what's going on in the overall market. And as you know, we hang our hat on the ability to avoid these correction two, correction three, bear one, bear two type of markets, keeping the powder dry, waiting for a better time for the market to be invested in. We're not going to try to catch any falling knives. It's time to kick back a little bit and monitor for relative strength to see what might we be interested in if the market decides to right itself. Let's look at a couple of charts. They all, for the most part, look terrible, not as bad as Tesla here with the clear break and down 12.3% today. Google, the other disappointment on earnings, and we still got a lot of big tech earnings coming up over the next couple of weeks. If they could provide some help to the market, or on the other hand, if there's disappointment, they could provide fuel to the downside. Here's NVIDIA breaking the 50-day moving average. We trimmed some. We're fully hedged on our remaining position. After hours, ServiceNow putting up some decent numbers. This is an AI software play, up 7% after hours. Chipotle reported it initially ran up near 60, but has pulled all the way back to 53 after hours as well. Anything else jump out that I want to show? Yeah, how about VRT, former data center sweetheart with liquid cooling, which is needed by NVIDIA's chips, reported earnings and not a good reaction there despite decent sales growth. Expectations very high for this as its PE has swelled to a 42, but now down near the bottom of this flat base that it's forming after being down 13.6% today on heavy volume. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, now's the time to come to Revere, not after you lose 20 or 15, 20% because your advisor has no sell discipline. You want to get out while you still have a chance to preserve your capital and come to a firm that has a history of being able to take care of its clients to the downside and participate when the market is favorable. And that's why we call our flagship portfolio GROTECTION. We participate when the market is acting well. And as you can see over the last couple of weeks, we work on getting the heck out of the way when the market deteriorates. Big chasm here for the market to play in. between the 50-day and the 200-day moving average. 200-day, we're still 9% above the 200-day moving average. So 4% off the high, 9% down to the 200-day. 200-day is sloping up. So as is typical, it'll be about a 12% loss off the high in the S&P 500 should we break the 200-day moving average. And then this is where all the serious bear markets occur, is under this black line. And as we come on videos every night and explain to you, we want to focus on the market and be heavily invested when the wind is at our back, not in our face. And you've seen that change very quickly over the last 2 weeks. And with that, I'm going to wrap it for Wednesday, July 24th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.